Have you ever wondered what really drives the seemingly uh, chaotic movements of global currencies? It often feels like a secret language, right?
It really can, yeah.
Well, today we're pulling back the curtain. We're taking a deep dive into an actual intelligence briefing from Forex analysts forecasting the U.S. financial session for July 9, 2025.
Quite specifics.
Exactly. Our mission to unpack what's actually moving markets right now will extract the most important insights, cut through the noise,
Get straight to the point.
and help you quickly grasp the complex interplay of trade policy, central bank actions, and market sentiment. Plus, maybe a few surprising facts along the way.
Sounds good.
Right now, global financial markets are navigating a really complex and, frankly, uncertain environment.
Yeah, tense equilibrium, I think is what the briefing called it.
That's the phrase. Primarily dictated by aggressive U.S. trade policy and, well, vastly divergent central bank monetary policies.
Big differences there.
And the next 24 hours, they're looking pretty pivotal.
It's a fascinating setup, isn't it? You've got these two, huge forces, trade and monetary policy, creating this real push-pull on the global economy.
Definitely a push-pull.
It's a delicate balance,
Mm-hmm.
and even a small shift can have huge implications for everyone, including you listening.
Okay, so let's unpack this dominant narrative then. The White House has been signaling some pretty significant new tariff proposals.
Uh-huh. The copper and pharma ones?
Yeah, exactly. A 50% tariff on copper imports and a potential 200% import duty on pharmaceuticals. Now, the stated aim, of course, is always, bolstering domestic production.
Right, that's the official line.
But what's the real economic fallout from these kinds of policies?
Well, the key insight here, I think, is that these tariffs create a kind of double whammy for the U.S. economy.
A double whammy. How so?
They simultaneously slow down economic growth and push prices higher through increased import costs. So that's what economists call a stagflationary shock. It's a truly tough spot for policymakers.
Stagflationary, yeah, that's not a good combination. Slower growth, higher prices.
Exactly. Bad news all around, typically.
Now, here's a truly surprising twist, though. Despite these big tariff threats, the U.S. dollar has actually nudged up slightly.
Yeah, which seems counterintuitive at first glance.
Yeah, totally. It seems the market is, looking beyond the immediate headlines, maybe focusing more on the broader path of U.S. monetary policy instead.
That seems to be the read. And if we connect this to the bigger picture, these protectionist measures, they aren't just contained to one country. This whole tariff-centric environment is a primary source of global uncertainty. In fact, the Swiss Re Institute has already revised its 2025 global GDP growth projection down. They cut it from 2.8% to 2.3%.
Wow, a 0.5% cut.
Yeah, and they directly cited reduced trade and heightened uncertainty as the reasons. It just shows how interconnected everything really is.
It really does. So that brings us to the Federal Reserve's policy paradox. They're on a real tightrope here, aren't they? Trying to balance these competing pressures.
Absolutely. A very tricky balancing act.
On one hand, you have potential inflation from increased import costs, right, from these tariffs, which would normally make them want to raise interest rates, the hawkish response.
Right. Got to fight inflation.
But then on the other hand, those very same tariffs drag on economic activity and trade, which typically lowers inflation and poses a risk to the Fed's employment mandate.
Their other job, yeah. Maximum employment.
So how do they possibly navigate this?
Well, that's the million-dollar question, isn't it? Given the Fed's dual mandate promoting maximum employment and stable prices, these opposing forces are pulling monetary policy in, different directions.
So what's at the play?
The most probable path for them, based on this analysis, is what we're calling a hawkish pause.
Hawkish pause. Okay, what does that mean exactly?
It means they'll likely hold their interest rates steady for now at the current 4.25, 4.50% range. But, and this is key, they'll keep talking tough on inflation.
So keep the rhetoric strong.
Exactly. Signaling they're ready to act if prices keep climbing. And this stance, fundamentally, it's supportive of the U.S. dollar, especially because other major central banks, like the European Central Bank, are actively lowering their own rates.
That divergence is key.
Huge divergence.
Okay, which brings us neatly to the single most critical event risk for the upcoming session. The release of the Federal Open Market Committee's, or FOMC, meeting minutes. That's today, July 9 at 2 p.m. Eastern.
Yeah, this is the big one for today.
You know, what I found particularly fascinating, and what I imagine you, our listeners, might be curious about, is this idea of language risk in the minutes. Why does the precise wording matter so much? It's just minutes from a past meeting, right?
Right. But the market is intensely focused on these minutes. They're looking for clarity on how the central bank is interpreting all these evolving trade and economic dynamics we've been talking about.
So reading the tea leaves.
Pretty much. The June monetary policy report already showed the Fed holding its target rate, sure. But the dot plot, which is basically where individual Fed members see rates going in the future, that actually revealed a more hawkish stance among them.
More members leaning towards hikes later.
Potentially, or fewer cuts than previously expected. So any subtle alteration in the tone or the emphasis in the written minutes today, well, that could force a broad realignment of market expectations. Big swings are possible.
Language risk. Wow.
It's truly a potential volatility catalyst.
Yeah.
The market right now is like it's holding its breath. It's in what's described as low volatility consolidation. We see the VIX index, the fear gauge, down at 17.60.
Pretty calm, relatively speaking.
Exactly. But these FOMC minutes, they possess the capacity to shatter that calm. The biggest risk isn't necessarily an unexpected change in policy today, but that language risk we just talked about.
How it's perceived.
Precisely. If the minutes sound more dovish than expected, maybe more members expressing concern over economic growth slowing down, it could lead to a sharp U.S. dollar sell-off. But conversely, a more hawkish tone would just reinforce dollar strength. So the key risk really in the next 24 hours, it stems from a potential market misinterpretation or maybe a genuine surprise within the Fed's qualitative assessment of the economy.
Okay, makes sense. So much writing on the nuances. Now let's dive into the currency pairs. The intelligence briefing analyzed 5 specific pairs.
Yep, chosen carefully.
Chosen for their sensitivity to these narratives, their liquidity, and the clear signals. We're going to look at what each tells us about the broader market picture.
Let's do it.
First up, USD, the euro versus the dollar. The primary trend here is bearish, meaning down, but with a high risk of a sudden reversal.
Right, and this pair truly sits at the epicenter of that stark policy divergence we mentioned earlier.
The Fed versus the ECB.
Exactly. The Fed's hawkish pause versus the European Central Bank's active easing cycle. Remember, they just cut rates by 25 basis points recently.
Okay, so what's the aha moment here?
Well, here's a critical insight, especially for traders. Almost everyone is betting against the euro right now.
Really? How many?
An overwhelming 75% of retail clients are short the pair. And institutions are likely short too, just given the fundamental backdrop.
Okay, so it's a crowded trade. Why does that matter?
Because it creates what's called asymmetric risk. If the Fed surprises everyone with a softer, more dovish tone in those minutes, all those traders who bet on the euro falling will suddenly need to buy back their positions fast.
Covering their shorts.
Exactly. Triggering a massive rapid price jump upwards, a short squeeze. And it often looks completely out of proportion to the actual news itself. It's a classic trap for the majority of the so-called pain trade.
Interesting. What about the technicals?
From a technical standpoint, the price is really consolidating. It's getting tightly coiled, like a spring around the daily pivot point.
Indicating indecision.
Yeah, market indecision before a potentially decisive breakout. It's just waiting for that catalyst, which could very well be the FOMC minutes.
Got it. So our confidence score for USD reflects that.
Precisely. It's moderate, a 6 out of 10 because of that extreme binary risk. It could go either way, quite sharply.
Okay. Next pair, USDJPY, dollar versus the Japanese yen. This one shows a strong bullish trend, meaning upward.
Well, this one's a bit clearer, fundamentally. It's driven primarily by that widening interest rate gap, the differential between the Fed's rates, 4.25, 4.5%, and the Bank of Japan's much, much lower 0.5% rate.
Huge difference.
Massive. And the BOJ's recent shift to a more dovish stance where they're slowing down their bond purchase tapering, that only reinforces this difference, makes the dollar more attractive relative to the yen.
So what's the key insight or the aha here?
What's particularly insightful is its momentum. Looking at the cyclical momentum, the current price is moving with extreme positive momentum. It's more than 2 standard deviations above its 30-day average. That's a plus 2.28 Z-score.
Wow, that's statistically significant momentum.
It is. So while this clearly screams bullish trend, it also hints that it might be a bit, let's say, overheated or stretched in the very short term.
So maybe wait for a dip.
Possibly. If you're looking to enter a new long position, a better opportunity might arise after a small pullback, rather than chasing it right at these highs.
Makes sense. And the confidence.
Our conviction for USDJPY is pretty solid, a 7 out of 10. You've got strong fundamental and technical alignment pointing upwards.
All right, moving on to GBP USD, sterling versus the dollar or cable. This one's showing a sideways to maybe slightly bearish trend.
Yeah, this pair feels really caught between worlds right now.
How so?
Well, it's obviously influenced by Fed policy like
Yeah.
everything else, but it also has its own UK-specific developments going on. And interestingly, the Bank of England's recent financial stability report specifically highlighted how vulnerable the global economy is to these trade risks we've been discussing.
So the UK is feeling that uncertainty too.
Definitely. And that makes this pair particularly sensitive. Now, the tricky part here is that this pair gives us conflicting signals.
Oh, like what?
Well, while its upward momentum seems to be fading, retail sentiment is actually strongly bearish. About 70% of individual traders are betting against it.
Which, as you mentioned with the euro, can sometimes be a contrarian bullish signal, right?
Exactly, that's the conflict. But wait, there's more. Large institutional players looking at open interest data have significantly reduced their positions. Open interest is down 34.70% from a year ago.
Whoa, big players are stepping back.
Suggests they're reducing exposure, maybe uncertainty. So you've got retail heavily short, which could mean a bounce, but institutions pulling back, which is bearish. Conflicting signals.
Yeah, that sounds messy.
It is. And that's why we're giving it a lower confidence score of 5 out of 10. It just makes for choppy, harder to read price action. Could get whipsawed easily.
Understood. Okay, fourth pair. IU-USD. The Aussie dollar versus the US dollar. Trend here is bearish.
Yep, bearish. And this one is often seen as a key indicator, like a barometer, for global growth and overall risk sentiment.
Because Australia's economy is tied to commodities.
Precisely. It's directly impacted by U.S.-China trade relations and, crucially, industrial commodity prices. That proposed 50% tariff on copper we talked about, that's a direct negative for Australia's export.
Right, a big copper exporter.
One of the biggest. So the real insight here is how the strong upward momentum this pair saw, say, last quarter, has pretty much just dissipated.
Fizzled out?
Yeah, totally fizzled. Over the last 30 days, it's barely gained anything, maybe plus 0.25%. This lack of upward energy, especially in what looks like a fundamentally bearish environment for it, that's a significant negative sign.
So fading momentum confirms the bearish view.
That's the take here. For AUD-USD, our conviction is strong again, a 7 out of 10. Good alignment between the fundamental picture and the technicals.
Okay. Finally, USD CAD. US dollar versus the Canadian dollar, or Loonie. Strong bullish trend here.
Yes, bullish. And this pair presents a really unique dynamic. You've got the strength of U.S. policy on one side,
The Fed, the tariffs.
juxtaposed with the influence of crude oil prices on the other side, which heavily impacts the Canadian dollar.
Ah, oil in Canada.
Right. So as these U.S. tariffs stoke fears of a global growth slowdown, what happens to oil demand?
It probably weakens, or fears are it will weaken.
Exactly. And weaker oil demand or prices tend to weigh on the Canadian dollar. So this creates a powerful pincer effect on USD CAD, squeezing it higher from both the U.S. strength side and the potential Canadian weakness side.
A pincer movement. I like that visual.
And this is where it gets really interesting for the analysis. This pair actually has the highest conviction bullish forecast among all 5 pairs selected.
The highest? Why is that?
Its recent momentum shift, looking at the Z-score again, it recently flipped positive to plus 1.13. That suggests a clear new trend is initiating after a period of consolidation.
So it's just starting its move.
Looks like it. And crucially, both retail traders, about 64% are long, and institutional sentiment seem to be aligned on this one. Everyone's kind of pointing in the same direction.
That confluence is powerful.
It is. This strong confluence across all the different analytical layers, fundamentals, technicals, sentiment, gives it an 8 out of 10 confidence score, the highest among the group.
Okay, an 8 out of 10 for USD CAD bullish. So let's pull this all together. What does all this mean for you, the learner, trying to make sense of these markets?
Well, the big picture from our analysis across all 5 pairs consistently reveals a market dominated by the strength of the U.S. dollar.
That's the recurring theme.
Absolutely. And that theme is underpinned by the Fed's relatively hawkish policy stance compared to other major central banks. And as we've hammered home, the FOMC minutes today are the primary risk event and the potential catalyst for the next 24 hours.
Got it. Dollar strength, Fed focus, FOMC risk.
Now, if we connect this to actionable insights, keeping in mind this is based on the briefing's analysis, not direct advice, the USD CAD pair presents what the briefing calls the highest conviction trading setup for the next 24 hours.
The 8 out of 10 confidence one.
That's the one. The bias is clearly bullish, meaning expecting it to go up. The suggested strategy would be to consider entering a long or buy position if the price pulls back slightly to a key support level.
So not chasing it, but waiting for an entry.
Right. The aim is to capitalize on the underlying uptrend, but potentially use any FOMC-induced volatility, maybe a quick dip, to get a more favorable entry price.
And specifically, the recommended entry price in the briefing is 1.3650.
Correct. 1.3650. And that's not just a random number. The analysis identifies it as a level where the price has historically found strong support. It's a confluence of technical factors, including the 20-day moving average and what's called the S1 daily pivot point.
A technical support zone.
Exactly. Suggesting it's a good area to consider buying, as the price often bounces from levels like that.
Okay, and what about the targets? Where might it go?
The recommended take profit level is 1.3780. That's identified as a significant resistance level, potentially aligning with a Fibonacci retracement level, where the price might stall or face pressure to turn lower.
And critically, risk management, stop loss.
Absolutely crucial. The suggested stop loss is 1.3590. That's strategically placed just below recent support and also below a key psychological round number, 1.3600.
So if it breaks below that, the bullish idea might be wrong.
That's the logic. And this specific strategy with those levels offers a favorable risk-to-reward ratio of about 1 to 2.17.
Meaning the potential profit is more than double the potential loss.
Correct. Which is generally what you look for in a decent trade setup.
Okay, it's very clear. So to recap everything, global financial markets are in this tense equilibrium.
Yeah, pulled between U.S. trade policy and the Fed.
Driven by aggressive U.S. trade policy, the Fed's hawkish stance, all culminating in these pivotal FOMC minutes today.
The main event.
This whole dynamic is broadly supportive of the U.S. dollar, and our deep dive into this briefing points to USD CAD as the highest conviction bullish play for the near term.
That sums it up nicely. But stepping back for a second. So what does this all mean, big picture?
Good question.
We've talked a lot about currency pairs, central banks, technical levels. But remember that these complex market dynamics, they ripple outwards. They don't just stay in the financial world.
True. They affect real life.
Absolutely. They influence global trade flows, the cost of the goods you buy every day, the stability of entire economies worldwide. So this deep dive into just a single market forecast for one day, it really offers a window into just how interconnected our financial world is.
A fascinating, complex web.
It really is. So maybe a question for you to think about is, how do you think these forces, the trade tensions, the central bank moves, how will they play out in the weeks and months to come? And what might that mean for the broader economy, maybe even for your own plans?
Yeah, that's a great question to mull over. How do these big forces trickle down? We hope this deep dive helped you connect some of those dots today.
Hope it was useful.
And as always, what other areas are you curious about? What else do you want us to take a deep dive into? Let us know.